Hi. Can anybody hear me? Everybody hear me? Okay, great. So I'm assuming now you can see the Charmer Charts Fibonacci Retracement program that I'm going to share with you this afternoon. Now we're looking at Fibonacci levels, and we're going to go through some of the reasons why you would use these in conjunction with your trading application. This is how to draw Fibonacci retracements. The Fibonacci retracement is created by taking two levels on a bull or a bear move. Doesn't matter what time frame, just two levels where you can see that the trade actually starts to motor away. And you put these lines in, a Fibonacci line, 0 to 100, and it will break down the correct retracement targets that we do. Once these levels are identified, we use them as possible. We use them as possible in determining where to enter or exit a trade. How widely are these fibs used in forex trading? I'm just being asked. They're used extensively and have been for many, many years. This is when I first started, it was 25, 38.2, 50, 61.8 and 75%. Over the years it's been based down to 23.6, 38.2, 50, 61.8 and now 76.4. The 61.8 retracement is normally the most important when the market pulls back quite a bit. This is what we know as, we call it the golden ratio. And the reason that is, it's the last line of defence before the 76.4 comes into play. And you either can sell or buy at this important fib. And you place your stops below the 76.4 or above the 76.4. And that normally gives you a good indication, keeps you in the trade longer than possibly you would be. If we look at the weekly chart of the S&P, now I've taken it back to May 2010, but you can see what I mean if you look at the low starting in February and we go all the way up to 12.17. You can see when it pulled back, it hit the 38.2 Fibonacci level. I think I can get this on the screen. Can you see this? Someone type yes. Okay. You can see what I'm saying. This big. Thank you. It's not vodka, it's water. Right, you can see here where we took the move. There was no other reason for that to top out there. We probably had a Fibonacci level there, to be fair. But you can see here now when we drew this in, you can see where it went back to the 38.2. It bounced off that level and then currently traded upwards to 14.74. Now, in something like this, I know this is a weekly chart because obviously this is a bit more long term, but in a strong uptrend, you do not expect the market to move below the 38.2 fib level. So you're looking first at the 23.6. If it breaks that, you look straight away for the 38.2. That should hold in quite a strong uptrend, and then up you go again. It's only when you start to come back through, that's the 50%, you're like, okay, we could go further. We could go further, lower or higher at that point. But to be in an uptrend, strong uptrend, 38.2 should be the lowest it goes, and off we go again. Now, you can use these Fibonacci levels over any time frame on any market. They work just as good. So I've showed you the weekly S&P chart, and this is a euro dollar. on a 60-minute chart. Now, I did this this morning. Now, you can see here where we corrected back to the 23.6 level. We couldn't break higher. The market did subsequently come down, broke below here, and last time I saw it, it was around about the 133.10 level. But you can see there that 38.2, which is 132.85. If you incorporate that Fibonacci level with the real strong support and resistance levels that you have, and we know the break point on the weekly chart came at 132.85. If you join them all together with your stochastics, which are here, you can see that, you know, they shouldn't be used on their own. They should really be used in conjunction with other indicators, oscillators, more importantly, chart support and resistance levels. But as I say, you can do it on a 5-minute chart. You're going to have a lot of lines and you're going to have to redraw a lot of time. But if you're a short-term trader, you can use it on whatever time frame you want to. Now, I've put this one in because everybody's looking at the euro and it is quite important. Now, I've got patterns. I've got a really good pattern here, but I'm not going to go into patterns until the next time if I do another one here. So you've got this base pattern in the euro. This is a weekly euro-dollar chart. You can see here when it hit the 50% fib level, and that was at 132.87. You can see then, you can see that, 132.87. You can see then where it came down to the 38.2 level, which was 129.89. Look again, look, you've got those two weekly moving averages as well. Now, these are not that overbought, so there is still room to go on the top side on the weekly. You see where it closed down here the week before. Last week, you could see it just moved up, hit the 50% line, closed above it, and we're now looking for it to go to the 61.8 level, which is 135.85, with your 200-week moving average coming in at 135.29. So you can see where the market is coming from. You've got that 60-minute chart for short-term traders. You've got the weekly chart for your long-term fund managing traders. So you can see they're used all right across the board. Everybody who trades does look at Fibonacci retracements because they're very important into entering and exiting a trade. Do we have any questions before I carry on? Someone, please. Anyone? Well, funnily enough, I have got the sterling yen chart weekly on my next little bit. I've got the dollar yen first because I thought, how can I show these phenomena, Fibonacci levels? How can I do that with a relevant currency that we're looking at, quite into, definitely looking at it. Look at the dollar yen. Okay, this is a weekly dollar yen, by the way. See where your stochastics are 92%. Now remember, on a weekly chart, that doesn't matter. They can go higher, but what they are used in conjunction with other oscillators, indicators, whatever. You look at that 76.4 level there, which is 90.40. Now that is your last line of defence. You see where I've put the Fibonacci start there? That was when I felt the market really started to travel on the downside. So we've been in quite a strong uptrend on the dollar yen, as we all know. So why would it stop there? It wouldn't. It is just the last line of defence. So you're going to see a lot of people selling in front of this Fibonacci line they're going to be selling in front of it, because if it breaks, then, you know, where do you go with the dollar yen or any yen? It's going to weaken considerably. So for the time being, that seems to be a good weekly, look, we're going back since 2010. That seems to be a good weekly, hey, you know, this market is beginning to turn indicator. So this is what you're going to be watching. It's really good. It was so confusing. Yeah, it is confusing, unless you're doing it all the time. And if you do it all the time, thank you, FX Bokeh. If you start to use these all the time, it's surprising how easy you'll be able to do it. You've really got to know where. Right, well, I didn't take the previous high because I like to see where a move comes from at the time when the market started to really motor away. So you could take it from up here to down here. Do you know what? But you really are missing quite a good trading opportunity if you do that, because you'd have to wait that much longer. So what you want to do is take it from the point where the market started to motor away from, say, on the downside. So this is where we stopped going higher, and from that point we started to trade lower. It's hard for me to tell you why and how I do it. It's just over 30 years I've done them each and every way, and this, for me, and what I do seems to work. Okay, so if it's not fixed, don't mend it. If it's not broke, don't mend it, sort of thing. With something like the chart I'm showing you now, your risk reward is very, very good, because your stops are very clear. You go above here, you're out. You're out of the trade. You know, you're wrong. It's in an uptrend. It's going up, and we're always looking for risk reward. So in that particular chart, your risk reward is for the market to come down another 300 points. For me, that's a good trade. You know, experienced lady. Well, yes, more water. It's surprising. That's right. That's exactly right. You should take a risk reward of 1 to 3. Now the markets have changed, and sometimes it's a 1 to 2 ratio, and you know, or let's take the profit while we can. It's that sort of thing. But in this trade, in the yen, because it's been such a strange, it's been a strong market. The others, not the yen. The yen's been very weak. The yen has weakened so significantly that you're looking for a correction. You're looking at stochastics at 92%. You're looking at it gone through the 61.8. You're looking at it, okay, look, it can't go any higher than this. If it does, we're not still in that major downtrend. We are going to be coming into a major uptrend. So this is why these Fibonacci levels are so important. They actually tell you what trend you're in, instead of having to sit there and go, all right, we have 3 trends: primary trend, secondary trend, short-term trend. It tells you what trend you're in, which is, I think, a very easy way of just eyeballing the market and going, hey, yeah, I can see that. Euro yen. Have we just lost the euro yen? Now, I'm sure so many people got caught in the yen move. Again, no, we can't. No, back to wherever. No, in the dollar yen, you can't say you're in an uptrend yet. You're in a short-term uptrend. Bearing in mind that uptrend's only been for a couple of months. You know, the major trend is down in dollar yen. What we're looking now is if we break that 76.4 level, yes, we're in a minor uptrend. If you saw where it come from, which I couldn't put on the chart and get it on my little thing here, because it would have just looked stupid. It would just been like a squiggle line. You would have understood more. But when I finished, go away, look at your monthly charts, and have a look and see where the dollar yen, euro yen, sterling yen have actually come from. It's quite surprising. So we look at the. I've done you a daily chart on the euro yen. So we've seen the dollar yen on a weekly. We're going to look at the euro yen now on a daily chart. And you can see, look, these are not confirming yet, but they look, you've gone sideways. It's not breaking up any higher. And especially after today's action, we're looking now for it to come down in that uptrend now, to come down and test the 23.6 level, which is 115.49. On the weekly. See, well, you want me to show you, don't you? Right, how can I...
Why we go back to that at the end?
I tell you what, why don't we do this? Okay, look, let's rattle through this course, all right? No, I don't consider fundamentals. It confuses me. But anyway, let me rattle through this course and say what I have to say. And what I'll do at the end of it, I'll get rid of the stuff that I've done, and we'll have a little bit of what you want. You know, do you want me to do a euro yen weekly? Whatever you want, just let me know. But let me get through this first and ask questions on what I've got in front of you. Is that all right? Okay. So, I feel so nervous. All my mouth's going dry. I feel like I'm dancing on ice. But anyway, can you all see that now? You're looking like you've got a double top. See it? A double top in this area. Only a baby one because there's no confirmation. But we are beginning to turn. And we do look like quite quickly we can come down to this area here. You can see where that wouldn't break the uptrend. You can come here and still not break the uptrend. It really is around here. You're going, oh, hang on a minute, you know. You can still buy it. Stops below this point here. But to miss all of that move, I think, is a bit of a shame. So although... Alright, Dr. Rob. I wasn't breaking too much for him. Absolutely. It's definitely counter-trending. But there are times you do that. Absolutely. Because say you're going to buy dips, right, being a trader, say you're going to buy dips, are you going to let it go 400 points down before you buy? No, not really. There are times when you can counter-trend the market. Not always, but in the case of the yen currencies, you can do this. You can do it because you know exactly where your stops are. So you're quite comfortable being short unless you go above here. You know, so here you're out. There you're short for that. Good risk reward. You're always looking for the risk reward. Do that more than anything else. If you think that's going to go down, it's a 15.49. Why still watch it go 400 points down? No, sell it. Then buy it back and buy more when it goes down to that Fibonacci level that you're waiting for. It hasn't confirmed it yet. What is when these converge down. So when that blue line crosses that red line, that's confirmation. But you can get a trade out of this by going, do you know what, look, it closed up. It's been down today, therefore it's telling me for the time being, and this one, for the time being, it's not going to go up anymore. And if it does, I'm quite happy to sell unless we go above here. Okay. Any further questions on that one? Well, you see, ASO and AB, I really don't know who they are. That's how little I take notice of other things. Who are they? Also a maybe. And we'll do that one. Dr. Rob, I'm really not sure about the question. Maybe it's me being stupid, but I'm not sure. Of course you do. Absolutely. Listen, I worked for Nomura Bank International for 4 years, right, which is why I don't do anything with candlestick charts apart from make them look pretty patterns. Of course, you have to keep your, you have to be aware of what they're saying. I don't. I'm a technical trader. I don't have to be aware of what anybody's saying. Okay. No, I don't use candlesticks at all. As I said, I just use them. I just put them up here because they're pretty colours and they're easy to look at. I learnt long time ago at Nomura Bank back in the early 80s, late 80s, that they didn't really work, so I've ignored them basically. I didn't, but as I say, they look nice on a graph. Now, but you can see here, see it better on a bar chart actually. See this here. It's not a clear reversal day, but it is a reversal day. Okay, look here. You've had divergence. You've had the price go higher, but the indicator lower than what it was over here. It's diverging. The technical indicators, for the first time since this move up, are diverging. They are looking like the market is going to come lower. No, I don't consider it economic data releases. In fact, you can use them to actually put orders into the market so that if on the headless chicken brigade run around just after the figures, it manages to spike up or spike down, you are filled. That's the only time I look at figures, really. I'm aware of them, obviously. Who's not aware of FOMC, Bernanke speaking, non-farm payrolls? But as a rule of thought, with so many coming out every day, so many meaning, so many things, so many interpretations of so many figures. Look, there's the chart. There it is. It tells me more than anything I can read, do, why make trading hard work? Now, it sounds awful, really, but why make trading hard work? At the end of the day, all you're in it for is to make money. That's it. Anybody could argue with that or want to say anything? No. Cool. Okay. So this is it. You're in it to make money. What are the stochastic settings? 10-3-3 on a slow stochastic. Don't use the fast stochastic because it will get you whipped around in and out. Now, you look at these. One of your best trading opportunities is when the daily and the 60-minute charts. Well, this is what I'm trying to, get across. Of course you don't want to be eaten by the big sharks. Who does? So this is why this is such an important thing I'm trying to get across to you. I've been doing this for many years. And banks, big banks, hedge fund, on my own, on the life market, in dealing rooms. I've done a lot. Okay, and you've got to. Oh, thank you, Christopher. You've got to be able to differentiate between the noise and the actual trading strategy that you're going to putting in place. And my last webinar, this was an introduction to technical analysis, why we did it, blah blah blah. I'm hoping to go through and show you bit by bit where the market is looking to put entry and exit points, and this is the easiest way I can explain to you. How do you set targets? Experience. I don't know. I can read a chart. Maybe that's I've seen it so many times. What economic data takes precedent over another piece of economic data? What is good news, bad news, I don't know. What I have seen is market anticipation of a figure. The figure comes out of market expectations. It's gone down and then scooted back up 150 points. So I don't put a lot of stock in economic data releases. It's not that I'm not aware of them. I just find it easier, and think that you will find it easier trading from a technical bias rather from a fundamental bias, because there's so many fundamentals out there, and you can't even, well, yeah, of course I do. I run trading desks in the big banks, you know, so of course I know that these are used in the big banks. Depending on what you're doing, you know, you can do it on a 60-minute. Okay, right, so we're looking at the sterling yen. We're all looking at the sterling yen. We've had a reversal day and we're going to come lower. So, here you are. 140.36 on sterling yen. Okay, let's see if that attracts that next time I'm on here with you. The Canada, look at that. Right, stochastics beginning to turn here. Okay. Market hasn't come down that much, so you'd be buying down here. You can preempt these. You can preempt the stochastics turning by using Fibonacci's with them. You're going to get people buying down to this level, down to 9,800, and these will turn. You'll be in front of the market, and up we should go. Just take a note of all these things that I've talked about with you, and see whether or not they come to fruition. This was the gold chart, okay? I took the Fibonacci from here down to here. We went up. We hit exactly the 76.4. We came down towards the 38.2. Up we've gone. Look, we've only managed to hold above the 76.4. So now I'll wipe them out, and I'll take another Fibonacci reading, because we've broken that. So that's obsolete now. Once you break the 76.4, you're out. You don't want to know. You're not in that trend anymore. Now, although these look overdone on the top side, while gold stays above 1679, it should trade higher. If it comes back to 76 point, no, below that, 1679, we will take the Fibonacci from here to here to see where it will come back to. But you know, just by eyeballing the chart, it's going to come round back to around 1670, 1669. Okay, Aussie, same thing, up, down, 38.2, up again. Okay, can you all see that one? Thanks, Forex Pal. Open close. My stocks setting is 1033. Well, I know Euroswiss is going up at the moment, but let me just get through this, because as FX Street has said, we are running out of time, I think. Oh no, we're not. We've run out of time that much. Right. Notes to remember. Now I've flicked through all the charts I had this morning. Now once I've done this, I can actually, you can ask me what charts you want to see, and I'll put them on the screen for you. Okay, that understood? Okay. Oh, whoa, hang on a minute, guys. But I can do all that for you, just hold up. Right, notes to remember. That was it. Now, what we can do is we can go back now, get my chart up. Oh, hello, husband. Hang on a minute. What's that? I've got a quote board somewhere here. There it is. Right. Well, It's nice, isn't it? Yes, nice couple. Sorry, let me just close you down a little bit. Oh, this is where you can't find it, isn't it? Okay. Now, God bless me. Thank you.
The occasion.
Oh, I got married. Yeah, I know. Right, sterling yen weekly, yeah? Now it's up to you now. You tell me what you want, and I'll put it up there. Let's look at... Now, I'll do it now. We have about 20 minutes.
When did you get married?
When did I get married? September. September, yes. Right, sterling yen then, shall we have? Euro dollar, okay. Okay, what time frame would you like? Thank you. Oh, so, okay, I'll do you, all three, Don Christie? You want me to do all three of the New Zealand? The Kiwi? Okay, I'll do that after I've done this. Okay, stochastics. Right, okay, I'll do that. What would you... Sterling yen. Right, well, somebody wanted the euro dollar. Not sure why, because we've been through the euro dollar today on the other one. But what did you want to know about euro dollar? I can go back and find out who you are. Mike. Current fibs on the euro dollar. Okay, let's go for the daily. We'll take it there, and the daily Fibonacci's would be there. So I know we're getting out of all this lot, but we've got this lot on your weekly and your monthly. So you just want this bit here from where it started to go up. Okay? You know here is resistance because you've got it on your chart. So that's why you put that point in yesterday. So the 23.6 is 132.31. And our low has been 133.10. We know our break point is 132.85. So if we break down to 132.31, we're going to have broken back below the weekly trend line. So we'll see it. We'll have a little watch and see about that one. Sterling yen. Okay. Sterling yen. You want the weekly? Oh, look. See what I said about that sterling yen? Or any of the yen? I mean, it's come from... So when you think, oh, God, how far can it go? Just look at this chart. It can go back a lot. But for the time being, we are going to look at it. We'll have a pretty little candlestick chart, shall we? We're going to have a look at it on a weekly chart. You want... It is. It's not looking good, is it? So we're going to take our Fibonacci retracement from here, put it up here, like that. 139.21. Let's put that one on there, 140.33. That's a bit more nearer, and you could be able to play with that. With moving averages, they're not really showing anything. 200-week moving average, well, we'll take that off, because this is what you're going to be watching as well on the weekly. You have to tie in the daily changes from bullish to bearish, so you just slip back into... Yep, the daily looks like it's changing. So this is how you can preempt a market move. You know, try and understand, there really is nothing magical about foreign exchange or futures markets. In fact, they really, really are quite simple. When you sit back and look at them, they're really quite simple to trade if you apply these basic rules, and that you apply them all the time. You can't do anything, you can't do one thing one day and ignore the same scenario the next day. You've got to have rules put in place that you trade with, and these rules that you trade with should be with you from what's my moving averages. Right, I use a 9, 21, 55 and 200. I do a simple moving average as well as an exponential moving average, so I have them all on there. What else? I'll show you a chart. This is a good one. Okay. This is how charts are spooky. In 2009, when the market was dying, I was asked where I thought the market would go. Now, I didn't really, apart from it's going down, was the only thing I could say. We had prior, in 2002, this. But look, when I connected that line to that line, it gave me that line. And that is where the market based in March 2009. It just based there, and up we went again. I'm showing you this chart because of this. Look at this major double top. Okay, so I'll take you back to when the S&Ps first started trading. Now, if you can see this, which you all can, I know you can, that is the 1987 crash. You remember the one that people were, hello, Mohammed, you finally got in then. Put me off these things now. This is where the market had its 1987 crash. Everybody was running around really upset. I mean, the bank dealings rooms were going absolutely crazy. Then look at the ranges now. This is such a significant chart pattern, and we really need to break here, above here, otherwise the stock market is going to fall, and it's going to fall back to here in the next 2 years, 2.5 years. So all is not looking well for the stock markets unless we break that significant top. I was going to do that on my patterns next time round, but anybody else want to look at anything else? Euro Swiss. Yeah. Euro Swiss is the market that does nothing and then moves bucket loads. Alright. That's your daily Euro Swiss chart. What can I tell you? The Swiss went lower. Now, when you've got a chart like that, I mean, really, there isn't much you can do with it, is there? The daily ranges on the last 1, 2, 3 days have been unbelievable. In a market that doesn't move that much. So if I take it out to the weekly, you can see, all of last year did nothing. Absolutely nothing. So to get an idea of where the market is going to go now, I'll do a Fibonacci retracement here. Now, as we now... Spooky. Okay, look at that. And I don't look at Euro Swiss. But you can see where the whole of 2012 was held by the 38.2 fib level. Now where we're going. You tell me. You've had your lesson for today. You tell me where you think that's going to go, please, Dr. Rob. Yes. No, JB, it's not taken. I've spent the whole lesson telling you why I don't take it from the high. Near 12603, and the reason it's going to go to 12603 is it's going to head for its 50% level. A market that does nothing for a year and finally breaks up is going to go and head for the next significant resistance, and that will be 12603. But the 03 is neither here nor there. So 126 is where the Euro Swiss is going to head for. I think it's going to head for it in the next 2 weeks. Anybody else? Oh, Kiwi. All right. Do you want Kiwi on a daily basis? Mohammed, get off the line. No, I didn't, Dr. Rob. I don't know. Hang on. There's so many coming through. 50% left. Yes. Well done, you. Exactly. Right, I'm going to do the daily Kiwi first, because that's what I was asked for. And then I can, yeah, it does trade risk on and risk off. Same as the Aussie, same as the Canada. Okay, do we want a daily, do we? On the Aussie, Kiwi? Okay. Okay, stochastic still showing pointing higher. However, you can see that top there, and that's virtually identical. So if you squidge that up, it looks like the Kiwi is going to come down again. So where is it going to come down to? Average. Let's take it from here. Right. It's... Right, hang on, Dr. Rob, and I'll be back to you. Right. So we're looking like we've made a top short term in the Kiwi. Where are we going to come back to? We've got these moving averages here. We've got the first 23.6, 83.45. You've got more support down at 80 to 63, and that's the area where that's going to come back to. I'm in Spain. I was in France, but I'm in Spain now. Southern. Sunny, but not warm at the moment. So we're going to come back to this 23.6. Now, if the Kiwi is going to be in a strong uptrend, it's going to hold that level or come back to 82.63. So those two Fibonacci retracements, the 23.6, 38.2, are important in a trending market. To your question, sterling Kiwi, to your question, which are the two most trending markets? I have to say gold. I think gold's a very good trending market. I know it's come off today, gone up today, but it's in a very strong uptrend at the moment. And I think the euro is going to be coming up. Right, Stacey, my settings for the SMA and EMA are 9, 21, 55, and the 200. Okay. Right, well that looks like it's going to come up, sterling Kiwi. And so we can put on our stochastics, our RSI, and then we'll look at our Fibonacci's and say, well, where is it going to come back up to? we have a very good chance of that coming back up to 194.05. Yes, Mohammed. That's the ones, yes. You see these stochastics down here? Here. We're looking for these to turn to confirm, but also you can preempt these with finding your support levels, so you're one step in front of the market, so that when they do turn, you already have the position. That's right, divergence. Divergence is what you're looking for when a trend starts to end. We don't look for divergence in the short term because it doesn't really apply. Right, now I've done my 45 minutes and I'm sure I'm going to get kicked off of here soon. So if I do, yes, of course, Ahmed. Small trades always make money. Listen, if you see a profit, take it. You know, because if you nick a little bit here and there, that's great, but make sure that you're in. Give yourself the best possible chance you can of making money. And believe you me, it is not on listening to the news every 5 minutes. That's just going to confuse you. Sit back, look at a chart, determine your trend time frame of what you're comfortable trading in. If you're a day trader only, you're looking at 60-minute, 30-minute. The swing traders, as you say, 1 to 3 days, if you can run them that long. You don't have to be in and out of that market day in all the time. Well, Ahmed, if you want to be a full-time trader all the time, you know, go on the web, find out as much as you can about technical trading. I say the words technical because you don't want to put too much information where 90% of that you don't need. Yes, I do. I have a live chat room and it's run off of Skype until Friday when the new website is being designed, or it's going to be incorporated in our new website. You can find me on Carol Harmer Skype or just Charmer Charts, www.charmercharts.com. Find me there. I hope you've really enjoyed this course. I've enjoyed it a lot more this time, and hopefully I'll see you all again soon.